This video introduces the efficient impact frontier, a way to think about the impact and financial performance of our investments in an integrated way so that we can increase both. In order to understand the efficient impact frontier, we first need to understand the concept of the efficient frontier from mainstream financial markets. At its simplest, traditional investing is about generating as much financial return as possible with as little risk as possible. Simply put, the concept of the efficient frontier is a formal way of exploring the relationship between financial risk and return. A portfolio that lies on the efficient frontier offers the greatest possible return for a given level of risk and for a given set of investment opportunities. It quantifies and explains how, once you've diversified and optimized your portfolio, to get more return, you have to take on more risk. In this chart, financial return is on the vertical axis, financial risk is on the horizontal axis, and each of the dots represents a portfolio of investments. You would want to choose one of the portfolios that is as close to the line as possible, because the portfolios on that line offer the most financial return for a given level of risk. That's why the line is called the efficient frontier. This chart is probably taught in every business school and in investment training in the world. It's mainstream financial theory, and people have won Nobel Prizes for it. But it leaves out impact. The impact of these portfolios on people and the planet is simply treated as outside the scope of this analysis. Investors increasingly do care about impact and want to find a way to bring it into the analysis while continuing to be good investors. Is there a way that this framework could be adapted or expanded to include impact? A lot of people have thought about this. It's not a new idea. What's exciting about the current moment is that more and more investors are putting the idea into practice. So how do we incorporate impact? It doesn't have to be complicated. On this chart, we've combined financial risk and return into the vertical axis to make room for impact on the horizontal axis. On the financial side, getting a higher return tends to carry more risk, and the same is true of impact. This summary chart merges financial risk and return into the vertical axis and merges impact risk and return into the horizontal axis. This is the simplest possible version onto which we can layer in more complexity as needed. Each dot on this chart is a portfolio of investments. As an investor, you would want to choose a portfolio that is as close to the line as possible, because the dots closest to the line offer the greatest impact for a given level of financial performance. This is what we call the efficient impact frontier. What's powerful about this is that it creates room for different investors to have different impact and financial goals, and therefore to construct different portfolios, and for each of those portfolios to be optimal. There is not one right answer, but multiple right answers, and each investor finds the approach that is right for them, optimal for them, or in the language of financial theory, efficient for them. As an example, we have two fictional entities, the Frontiers Foundation and the Frontiers Pension Plan. Both have looked at the same set of investment opportunities and made different choices that fit their goals and needs. Frontiers Pension Plan, as an investor with a fiduciary duty to its pension holders, constructed a portfolio that falls more to the financial side of the frontier, but still has more impact than it could have had. And Frontiers Foundation, as a philanthropic body with greater flexibility around financial returns, constructed a portfolio that falls more on the impact side, but still has more financial return than it could have had. Neither is a bad investor, just two investors who constructed different portfolios to express their different goals. That doesn't mean that anything goes. Look at the portfolios highlighted in red. You wouldn't choose those portfolios because in each case you could find a portfolio closer to the frontier that offered at least the same financial performance and more impact, or the same impact with more financial performance. Frontiers Foundation might be willing to accept more financial risk to achieve more impact, but it doesn't want to take more financial risk than is necessary to achieve that impact. Frontiers Foundation and Frontiers Pension Plan constructed different portfolios, but neither wants to leave impact, financial performance, or both on the table. This is broadly the assumption that we're making about investors, and we invite you to consider whether these assumptions are true of you too. We're not assuming any particular financial goal, and we're not assuming any particular impact goal. And we're not assuming any particular balance between impact and financial goals. We are assuming that holding impact constant, you prefer greater financial performance. And we're assuming that holding financial performance constant, you prefer greater impact. And when we put the above statements together, they lead us to a final assumption, which is that you don't want to leave impact, money, or both on the table. Now, if you're Frontier's Foundation or Frontier's pension plan, and you were looking at all of the investments available to you, how would you go about constructing your portfolio? This chart is a little bit different than the previous. On this chart, each dot is an investment. To the right, we have investments with higher impact, and toward the top, we have investments with higher financial performance. This is illustrative data. Our goal here is not to make an assertion about whether or not there are trade-offs between impact and financial performance. There isn't enough data to say. Investors we have worked with have found that sometimes there is a trade-off and sometimes there isn't. In other words, there may not be one universal answer to the trade-off question. On the vertical axis, how to evaluate risk-adjusted financial return in finance is fairly well understood. To get to one number to use for impact on the horizontal axis, investors can create an expected impact rating. And then you can put them together to create this scatter plot of your potential or actual investments. The scatter plot provides a way of assessing any investment on both dimensions and benchmarking prospective investments relative to those already in your portfolio, so that you can make better portfolio allocation decisions and improve the impact of your portfolio over time. If you're Frontier's pension plan, which would you choose? You'd probably start with the investments that offer the best financial returns at the top of the chart. But for any given level of financial performance, you'd start with the highest impact investments on the right and work your way to the left. And you might end up choosing the investments circled here. Basically the top financial ones, but with a bias towards impact wherever possible. Of course, this is a simplification. Correlations between investment performance can complicate this picture, especially in public markets. But this is a helpful starting point and may be sufficient in private markets where correlation between asset prices is less of a consideration. And if you are the Frontier's Foundation, which would you choose? Well, you'd probably start with the investments that offer the greatest impact on the right side. And for any given level of financial performance, you'd start with the highest financial investments at the top and work your way down. You might end up choosing the investments circled here. Basically the top impact ones, but with the bias towards financial performance when all else is equal from an impact perspective. This slide bridges the investment level and the portfolio level. It shows how Frontier's pension plan's choices of individual investments translate into its portfolio on the efficient impact frontier, and how Frontier's Foundation's different choices of individual investments translate into a different portfolio that is also on the efficient impact frontier. And that's what the efficient impact frontier is. Just a set of portfolios that each offer an optimal combination of impact and financial performance. When investors undertake this exercise for the first time, often on a legacy portfolio, it may reveal significant opportunities to improve that portfolio. Let's imagine that each dot on this graph is an investment in a legacy portfolio. There are several investments in the lower left that have both lower financial performance and lower impact performance. Those might be ones to consider exiting. Of course, it seems obvious when it's laid out in a graph like this, but it may not be obvious for investors that haven't looked at their portfolios this way. And you don't need a large portfolio for this exercise to be useful. Even in a portfolio with 5 to 10 investments, analysis like this can show that some investments clearly offer greater impact, stronger financial performance, or both, than others do. Now let's imagine that you're beginning to transition out of that legacy portfolio and you go out and find a number of new investment opportunities, shown here in teal. Some of these prospective investments offer both high impact and high financial performance. In principle, this investor could simultaneously improve both the impact and the financial performance of their portfolio just by dropping the yellow legacy investments in the lower left and reallocating that capital to the teal prospective investments in the upper right. Now we'll look at a simple investment strategy that pulls together impact and financial considerations for an investor such as the Frontiers Foundation that does not need to maximize risk-adjusted financial return. We've divided the chart into 4 quadrants. On the horizontal axis, we have high and low impact, and on the vertical axis, we have high and low financial return. An investor like Frontiers Foundation might start by screening out these investments in the lower left that are both low impact and low return, then look to see if there are any prospective investments that offer both strong impact and financial performance. It's great when you can find investments in this quadrant, but you'll want to watch out for impact washing and validate for yourself that the impact is as compelling as promised. Frontiers Foundation might then look to the lower right quadrant and try to do as many of the highest impact investments as they can find, even if those investments are not the most profitable. And finally, any capital remaining can be deployed in the high return, low impact quadrant on the upper right to generate cash to invest in high impact investments in the future. This is just one example of an integrated investment strategy. The framework is flexible. Each investor can use a chart like this to articulate what strategy will make the most sense for them. What does this enable investors to do? Coming back to the chart in which each dot is a portfolio, whether your priorities lean towards impact, financial performance, or right in the middle, everyone will want to move up into the right as much as possible toward the efficient impact frontier, because otherwise you're leaving costless impact, money, or both on the table. If you're working with a legacy portfolio, that portfolio may be well inside the frontier, meaning that you may have a lot of room to choose investments that get more financial return without sacrificing impact, or more impact without sacrificing financial return. The more you optimize your portfolio for impact and financial performance, the closer it moves to the frontier. Eventually, you may reach the trade-off zone where you can't improve impact any further without sacrificing financial performance, and vice versa. Once you get to that point, you can move along the frontier in either direction, toward impact or toward financial return, depending on your goals and constraints. Investors that have fiduciary obligations can be confident that their capital is optimally allocated for impact in a way that is aligned with and supportive of those fiduciary obligations. And investors that move even further along the frontier in the direction of impact can have greater confidence that their catalytic capital is allocated to the highest impact opportunities where it can do the most good. In summary, this approach enables investors to understand the financial, social, and environmental dimensions of their investments in a comprehensive way, to optimize investment performance across those dimensions, and to communicate all of the dimensions of their investment's performance clearly and transparently, so that all investors can build a financial sector that better serves society.